Economic growth in the Eurozone accelerates to a 7-month high. Well, PMI data in the bloc rose to 50.4 in March from last month's 50.2. Now, don't forget, anything above 50 represents expansion. However, the number was still below what had been predicted in a Reuters poll. But there was a first increase in German manufacturing production for almost 2 years. Russ Mould is investment director at AJ Bell. Russ, on the face of it, this seems like good news, but does this mean stronger growth now in Europe?
Well, I think that's clearly the great hope. And, if you have, for example, looking at an index like the DAX, there's at an all-time high, even though, nothing but bearish things have been said about the German economy for the last 2 years. There are clearly great expectations. And at least these numbers do give some hope. European manufacturing PMI at a 26-month high, for example, output is accelerating. Job cut expectations seem to be going down. If there is a weak spot, it's that orders aren't particularly strong. But I guess if even the German government can only spend the money so fast. So let's see what happens in the next few months.
Well, you mentioned the German government there. Well, last week was a pretty momentous one for them after the country decided to ditch its fiscal rules and announce a €500 billion infrastructure fund. Do you think Europe's biggest economy is now on the right path as a result?
I think it's certainly on a better path than it was, even if you could argue it's a classically European solution to a problem. Whether it's been the great financial crisis, the European debt crisis, or COVID, the solution has been change the rules and borrow more money. And that's exactly how Germany is dealing with it. You can understand why. And yet, it does now seem to be on a better path than perhaps you could say it was.
Now, what about the threat of tariffs? Can measures like what Germany have taken outweigh the negative impact of them?
And that's clearly what they're hoping. I mean, we don't know exactly what the President of America is going to impose on the 2nd of April. We'll find out. And I guess there are still hopes that some deal in some way, shape or form may be done. But Europe, I think, if it has to industrially retool and it has to respond to American tariffs through developing its own sources of manufacturing, then that's the way it's going to have to go. And at the moment, that's the way markets seem to think it is going to go.
Well, let's look ahead to later in the week. We have the spring statement in the UK. What are you hoping to hear from Finance Minister Rachel Reeves on Wednesday?
Well, as somebody who believes in free markets, as little as possible will be quite helpful, but that's probably not what we're going to get. I mean, if anything, I can understand why the Chancellor feels that she's under pressure. She gave what she felt was a major landmark budget last October to set out the government stall for the next 5 years. And within 5 months, it looks as if the numbers aren't adding up. It's probably not fair to judge anybody on the basis of 5 months in power, but unfortunately, that's the way markets are. And with the increase in the UK government 10-year bond yield, that is putting some pressure on the Chancellor to be seen to be doing something, even if giving businesses and consumers a chance to adapt to the last set of changes would probably be a better course of action.
And just quickly, Russ, mining stocks are leading shares in London today with copper prices up too. What's going on here?
Yeah, copper's nearly at $10,000 a ton again. This may be a tariff and Trump and trade situation. Traders may be worried about aluminium and steel tariffs leading to copper tariffs, and therefore they're scrambling for inventory and supply just to protect themselves. It may equally be traders taking a slightly bigger picture view and maybe pricing in inflation or even, dare I say, stagflation because of Trump trade and tariffs. If you look at the CRB commodities index, it's crossed the 350 mark, going up for only the third time in its 30-year history. So maybe harder assets are coming back into fashion, possibly at the expense of paper assets like bonds and cash that have done so well in the low rate, low growth and low inflation environment we've seen for the last 15 years.
Well, that was Russ Mould from AJ Bell. And don't forget, you can watch more videos on Reuters.com.